President Biden has pledged $6 trillion of federal spending over the next decade, more than any other president in recent history. How will his plans be financed? How will these financing activities have any impact on the markets? Well, we're here to talk about this very topic with Michael Lee, founder of Michael Lee Strategy. Mike, it's your first time on Kitco. Welcome.
Thanks for having me.
Now, as you know, Biden has made a speech to Congress this week, and we're going to take a listen to some of these clips. The first one I'd like you to address now, Mike, is whether or not the proposed tax increases, capital gains tax, corporate taxes, whatever the case may be, would have any significant market impact. Let's take a listen to what Biden has to say about taxes first.
I made it clear we can do it without increasing the deficit. Let's start with what I will not do. I will not impose any tax increase on people making less than $400,000. But it's time for corporate America and the wealthiest 1% of Americans to just begin to pay their fair share. Just their fair share.
Okay, Mike, so this is obviously a change of tune from what we're used to under the Trump administration. Do you think it will have any significant market impacts at all? I mean, following Biden's speech, we haven't seen any significant market moves from the S&P 500 or Dow Jones.
I think the market impact is limited because I think all of these proposals that he talked about are just plain and simple liberal nonsense, and they're dead on arrival. All right. It's now, I'm going to take you back to 2017 when President Trump's first big act was to try to repeal Obamacare. Okay. And it's a misstep by a president to go too big, too hard, too fast. So when Barack Obama tried to bring Obamacare as his first major legislative action, it led to the biggest loss in the House of Representatives and the Senate and across state houses in a single election in U.S. history. So when you try to go too big, too hard with the hope of settling somewhere in the middle, you normally fall up short. And so when Trump tried to repeal Obamacare, John McCain played the role of the foil, where he was the one vote that stopped it, where in reality there was probably 4 or 5 Republican senators behind him that were also uncomfortable with repealing it. And John McCain was all too happy to be that, the silver quiver to take that one out. I think there are probably 4 or 5, if not more, Democrat senators that look at this, that this is a bridge too far, these things that they're proposing. And you already have Joe Manchin and Kristen Sinema who are out there opposing it. So those two are playing the role of the foil for anything that's crazy. If they were serious about modest tax increases, so taking the capital gains from 20 to 25, taking the corporate tax rate from 21 to 26, right? And they started talking about low numbers, exactly where they wanted to end up, versus so aggressive with all this $1 trillion Green New Deal stuff, that all those things poll in less than 20% in terms of people that strongly favor. So you're looking at a 2-to-1 or 3-to-1 oppose, and there are people out there that realize that aren't going to get on board. So I think it's the market is saying what I'm saying, which is all these proposals are just pie in the sky, things that'll never come into fruition.
Okay, that's interesting. So there's a low probability chance that he's going to actually be able to raise corporate taxes and capital gains taxes. As an investor, though, does this not concern you? If there is even, let's say, a 25 or 50% chance, would you not be taking profits right now?
Oh yeah, absolutely. Look, the way the statist views, profits and income is that it's the state's property. It's the state's money. So the fact that the Senate is split and you have the tie-breaking vote is your only comfort in that situation. Had they had another seat or two, they can raise taxes and budget reconciliation. So this is not breaking the filibuster or anything groundbreaking, and the taxes will probably go up. But in terms of the stock market, so if capital gains were to double for the top 1%, yes, I would be looking at other places to move your money. Who that really hurts is the aspiring wealthy, not necessarily the ultra wealthy. I mean, I work on things for my clients to shield their capital gains so that whether the rate's 20% or 40%, It's irrelevant. So the ultra wealthy who, they're supposedly targeting, there's very sophisticated tools out there so that they're not paying any capital gains anyway.
Okay, so let's talk about the stock market overview in just a minute. I want to come back to another one of Biden's remarks. This one concerns, in my view, inflation. So he wants to, in his words, raise the minimum wage to $15 an hour. It seems like for all states. Let's take a listen and then we'll interpret his message.
And by the way, while you're thinking about sending things to my desk, let's raise the minimum wage to $15. No one working 40 hours a week, should live below the poverty line.
Okay, so this comes back to Jay Powell's statements about inflation being transitory and not persistent. Now, if we were to see federally mandated $15 an hour minimum wage, which some states have already looked at, but let's say we have it for the entire nation, how would that change input prices?
Yeah, look, I think for what you think of off the top of your head as a minimum wage employee, somebody that works at some sort of fast food or in some service industry, automation will just take hold, right? So, I don't know that. This fight is really a big deal, and it's a $15 minimum wage for anybody that's working 40 hours a week. I don't like that. That's the opposite of what I was just talking about. That poll's very high. It's very reasonable. Yeah. I can't see of that having a huge impact. But the way to get that is, so the fight for 15 has existed since like 2003 or 2004.
Yes.
Right.
Yes.
We are 16 or 17 years later, and it's now, if you're trying to hire someone for minimum wage, you can't find bodies. Now it's because of unemployment. Prior to the pandemic, it's because there were no employees out there. So this is something that if the Biden administration was smart, they would lead with, right? Because it's reasonable, it's doable, and it won't, productivity through innovation and automation will take out the inflation aspect of it. There will be less minimum wage jobs out there, but this is something that's very reasonable and very practical in 2021, which might not have been reasonable or practical in 2002 or 2003 at Walmart in, the middle of America. Does that make sense?
That certainly makes sense. What is your view on inflation? We have unemployment at 6% currently. It's come down significantly since, highs from 2020. But I wonder if unemployment needs to come back even further down from 6% in order for inflation to pick up. What do you think?
Yeah, look, I don't think we're in the U.S. we're going to have meaningful inflation ever again. I think. Wow. Yeah, look, we've Japanified our country. What you've done through the endless printing of money, it hyperinflates financial assets, and it crushes the velocity of money through the system. And it's the velocity of money, in my opinion, is the key driver of inflation. I am in total agreement with Jay Powell that most of the inflation issues we're seeing right now are transitory. There are serious supply issues that are pandemic related that will pass. So as these things pass, as suppliers and commodity miners and manufacturers can match supply and demand, because there is a demand surge right now as people are getting back online. And most economists, most analysts have underestimated the snapback that the economy, especially in America, was going to see. So once that levels out, a lot of this price inflation is going to go away. You're going to have a lot lower year-over-year comparables 2 or 3 years from now. When you flood the zone with money the way that we have, banks simply cannot lend it out. And if you looked at Bank of America or JP Morgan's earnings from last quarter, you could see that their deposit growth is far outpacing their loan growth. So what happens over the last year, M2 has increased at 25%. The velocity of M1 has declined by greater than than 25%. So there's a great chart to look at, and it's the Fred blog. If you look at the velocity of M1, you go all the way back to when we leave the gold standard, and it looks it's a straight up chart until right before the financial crisis, and then it starts to collapse, and it really collapses during the first round of quantitative easing. So what happened is the overregulation of banks. Instead of the government saying we made a mistake by trying to make homes affordable for everyone, they said it was the banks that took on excess leverage. We're going to regulate the living daylights out of them. And now you destroy the velocity of money in our economy. Then you start printing, and monetizing. You're printing money and monetizing your debt, which further slows the velocity of money down, but it inflates the stock market and other financial assets to mask over these other economic deficiencies. So when you are the reserve currency, when you're the major player in the world, and your GDP drives the world economy, you don't get hyperinflation the way you do in Zimbabwe and Venezuela. Right? It's a very different play out here, and too many people are looking at those countries and not looking at what's happened in Japan. So when you just start printing money like this, you're essentially, unless you use it like in World War II, where you have this high manufacturing, high output, high type velocity things for your economy, you end up just pulling stock returns, and you depress bond returns, you crush savers, and you pull stock returns forward. So I'd say the stock market is going to keep going crazy until the money stops printing.
Okay, I have several things to follow up with you on following what you just said, Mike, including the stock market and the Japanification of our economy, so to speak. But first, I want to go back to what you said about the money velocity. Now, it is true that the aggregate demand has fallen in 2020, but it's more or less picked up according to a few indicators. If you look at retail sales, for example, issued by the St. Louis Fed, it's more or less picked back up to above pre-COVID levels. Now, people are saying that once the lockdowns are over, the first thing they're going to do is spend money and travel. Savings rate is still very high. It's come down a little bit, but it's still very high. People have this pent-up need to just unload their cash. What would you say to that argument?
Retail sales hit an all-time high, I believe, in September of last year, right? And so we've been making new highs since then. And so what you have in our country is you have haves and have-nots. And so the people that have are out there, they're spending, they're traveling, they're getting vaccinated, and all these things are taking off, right? So I again, until money can make it through the system, and until banks can start lending aggressively, which I don't know that will ever happen again, because I think we're in a permanent stage of zero interest rate policy. And when rates are that low and there's so much money in the system, you simply can't lend it fast enough for that. So that's my key blockage for inflation. And when you talk about the savings rate, if you look at the savings rate in 2005 and 2006, it doubled after the financial crisis, and it stayed there. So I would say after this pandemic, you're also going to see a phenomenon where you have a much higher savings rate, similar to where? Japan. So after these shakes in our economy, people, I think, will be less gun shy about this pandemic and the financial stress caused from it the way they were of 2008 and 2009. But I think you're going to see a savings rate that's permanently higher. So you went from 2.5%, 3% to 4.5%, 5%, maybe 6%, up to 8 or 9% now, and that may be where the savings rate stays for good.